If I had to look at this stock market today from scratch, knowing what I know about record highs, artificial intelligence excitement, defense demand, aircraft shortages, restaurant pressure, and the electricity bottleneck that is starting to appear underneath the whole economy, I would not assume the market is getting every stock right. Most people think investing is about chasing the cleanest chart, the loudest story, or the company everybody on Wall Street suddenly agrees on. But that is not where the best opportunities usually show up. They show up when the business is complicated. They show up when the headline looks scary. They show up when everybody has already decided the story is too messy, too boring, too risky, or too strange to care about. And right now, I think there are 4 stocks where the market may be doing exactly that. Not slightly misreading them. Really misreading them. Now, I am not saying these are perfect companies. They are not. Some of them have serious problems. Some of them need to execute. Some of them can disappoint you badly if the thesis breaks. But that is the point. If everything was obvious, clean, and comfortable, the opportunity would already be gone. Today is Wednesday, April 29th, New York time. Comment below what day and date you are watching from, because I always like seeing where everyone is watching from. And if you value this kind of breakdown, support the channel by subscribing and comment John A.G. Best, so I know you want more research-heavy stock videos like this. So let's get started. The first stock is Boeing, and I know what some of you are thinking. Boeing? Really? Because this company has been dragged through years of bad headlines, production problems, safety concerns, regulatory pressure, supplier delays, cash burn, and investor frustration. The market does not trust Boeing, and honestly, I understand why. But investing is not about asking whether the past was ugly. It was. The question is whether the market is treating ugly as permanent. That is different, because Boeing still sits inside one of the most important industrial markets on Earth. Airlines still need planes, fleets still age, travel still grows over long periods, and aircraft manufacturing is not a business where 10 new competitors suddenly show up next week and take the market away. This is still a deeply concentrated industry. That gives Boeing something most broken companies do not have: time, demand, and a backlog. Based on the latest company update, Boeing reported first quarter revenue a little above $22 billion, driven by 143 commercial deliveries, and total backlog rose to about $695 billion, including more than 6,000 commercial airplanes. That is not a small pipeline. But here is where people get lazy. Backlog is not profit. Backlog is not cash in your pocket. Backlog is work waiting to become money, and Boeing only earns that money if it builds the aircraft safely, gets them approved, delivers them, and keeps customers confident enough to wait. So the real Boeing question is not, do they have demand? They do. The real question is, can they execute without breaking something else? That is why this stock is dangerous, but also why it is interesting. The FAA cap on the 737 MAX production rate was put in place after the Alaska Airlines door plug incident, and as recently as last year, officials were still not ready to lift it. That shows you how much trust Boeing has to rebuild. But if production keeps moving in the right direction, even slowly, the math changes. More deliveries mean more revenue. Better production discipline can reduce waste. Fewer disruptions can help margins. And eventually, if management does what it says it is trying to do, free cash flow can stop being a promise and start being something investors can actually measure. Do I think Boeing is low risk? No. This is an execution stock. It can punish you. A bad quality headline can erase months of patience in a single morning. But if the market is pricing Boeing like the problems never improve, while deliveries and backlog say the business is still alive, then there is a disconnect. And disconnects are where long-term investors should at least pay attention. The second stock is Lockheed Martin. This one is completely different. Boeing is disliked because the story has been messy. Lockheed is ignored because the story is boring. And boring can be a gift when everybody else is busy chasing whatever artificial intelligence name is up that week. Lockheed does not need to be exciting. It sells things governments keep buying when the world feels unstable. Missile systems, aircraft, space systems, command platforms, defense technology, maintenance, modernization. This is not impulse spending. This is national security spending. And in the current world, national security budgets are not exactly fading into the background. According to recent company results, Lockheed finished last year with a record backlog of nearly $194 billion, representing more than 2.5 years of sales. Then, in its first quarter update, management reaffirmed full-year guidance and expected free cash flow in the mid-$6 billion range. That is the part investors may be underestimating. Visibility, not perfection. Visibility. Now, let's be fair. Lockheed has problems too. Recent results showed pressure from production delays and rising costs in certain fixed-price programs. Some aircraft and defense programs are complex, and when complexity meets inflation, labor shortages, parts shortages, and government contracting rules, margins can get squeezed. So the skeptical view is not stupid. If execution slips, the stock deserves some pressure. But does that mean the whole business is broken? I do not think so. A company with a record backlog, defense demand, long program cycles, and steady cash generation is not the same as a hype stock that needs investor excitement just to stay alive. Lockheed can be boring and still work. Actually, that may be the whole point. While capital keeps crowding into high-growth tech, defense cash flow has become easier to ignore. The market looks at Lockheed and says, not exciting enough. I look at it and say, maybe that is exactly why the valuation is more interesting. This is not a get-rich-quick story. It is a cash flow story, a durability story, a stock that probably will not make your friends impressed at dinner, but might quietly matter inside a long-term portfolio if the price is right. The third stock is Toast. Now, Toast is the one where you need to be more careful, because this is not a defense contractor, and it is not an aircraft duopoly. This is a growth company trying to prove its model can become truly profitable at scale. Toast builds technology for restaurants. Payments, ordering, management tools, software, data, and the operating layer that helps restaurants run the business every day. And once a restaurant builds its workflow around a platform like that, switching is not simple. It touches employees, it touches menus, it touches payments, it touches customer ordering, it touches reporting. So the business can be sticky. That is the good part. The market's concern is also obvious. Restaurants are hard customers. Labor costs are high. Food costs are high. Rent is high. Consumers are selective, and restaurant owners do not usually have unlimited room to spend on technology just because a software company wants better margins. So investors look at Toast and say, nice growth, but show me the profits. And they are right to ask. Growth without margin expansion is just a more expensive way to stay busy. But here's the part the market may not be giving enough credit to. Toast ended last year with annual recurring revenue above $2 billion, up in the mid-20% range, total locations around 164,000, and gross payment volume above $51 billion. Gross profit in its subscription and financial technology segment also moved higher at a healthy rate. That tells you demand is not dead. Customers are still using the platform. The question is whether that demand turns into better operating leverage. That is the entire Toast thesis. If Toast keeps expanding locations but profits do not follow, investors will lose patience. They should. But if revenue keeps compounding, retention stays strong, and management proves margins can widen, the stock can go from interesting growth name to platform business the market underestimated. That is a big difference. And this is also where I would push back on the easy bullish argument. Do not just say restaurants use it, therefore the stock is cheap. No, a good product is not automatically a good investment at any price. You still need the valuation to make sense, and you still need proof that scale produces real cash flow. Toast has the ingredients. It has not fully earned the benefit of the doubt yet. That is why the opportunity exists, but it is also why the risk is higher. The fourth stock is Vistra, and this one brings us into artificial intelligence, but not through the front door. Everybody talks about chips, everybody talks about GPUs, everybody talks about the companies building the models. But artificial intelligence does not run on excitement, it runs on electricity. And that is becoming one of the biggest hidden constraints in the whole market. Data centers need power, a lot of power, reliable power, around-the-clock power. And the grid in many areas was not built for this kind of demand shock. Recent energy data shows United States power consumption hit record levels last year and is expected to keep rising through this year and next year. A separate global energy update showed data center electricity demand grew sharply last year, with AI-focused facilities rising even faster. That is not a small side story. That is the backbone of the AI build-out. Vistra owns power generation assets, including nuclear and gas exposure, and that puts it in a very different conversation than a normal slow utility. This is where the market may be confused. It sees a power company. I see infrastructure behind the AI economy. Now, that does not make it risk-free. Power markets are messy. Commodity prices move. Regulations matter. Hedging can create ugly accounting swings. Weather matters. Outages matter. Political pressure matters. If expectations get too high, even a good business can become a bad stock for a while. But the long-term demand setup is hard to ignore. Vistra reported full-year adjusted EBITDA close to $6 billion and adjusted free cash flow before growth spending around the mid-$3 billion range, even though reported net income was affected by hedge-related losses. So again, you have to separate the headline from the machine underneath. If electricity demand keeps growing, if data centers keep signing power agreements, and if reliable generation becomes more valuable, Companies like Vistra may not be valued like sleepy utilities forever, and that is the bigger point across all four names. The market is not always wrong because it is dumb. Sometimes it is wrong because it is impatient. With Boeing, it sees scars. With Lockheed, it sees boredom. With Toast, it sees unfinished profitability. With Vistra, it sees a utility instead of an infrastructure bottleneck. Those are four very different stories, but they all come back to the same question. Is the market pricing the current problem, or is it pricing the future reality? Because if the future reality is better than the current fear, that is where opportunity can show up. Not guaranteed, never guaranteed, but possible. And possible is where research starts. And there is one more thing I want you to notice. These four are not the same kind of bet. That matters because investors get themselves in trouble when they treat every idea like it has the same job. Boeing is a repair story. You are not buying perfection. You are watching whether the repair is real. Lockheed is a patience story. You are watching whether cash flow and backlog eventually matter more than excitement. Toast is a proof story. You are watching whether growth finally turns into operating leverage. Vistra is a bottleneck story. You are watching whether electricity becomes one of the most valuable parts of the AI supply chain. So if you look at them, do not ask, which one is the most exciting? That is the wrong question. Ask which thesis is easiest to track. With Boeing, track deliveries, safety updates, free cash flow, and whether backlog converts without another major disruption. With Lockheed, track order flow, program costs, margins, and whether defense budgets translate into profitable revenue instead of just busy factories. With Toast, track recurring revenue, location growth, gross profit, customer retention, and whether operating margins keep moving in the right direction. With Vistra, track power prices, generation availability, hedge impact, debt, and whether data center demand turns into long-term contracted value. That is how you keep yourself honest, because the market will always give you a story, a scary story when it wants you to sell, a beautiful story when it wants you to chase. But your job is not to react emotionally to the story. Your job is to build a checklist and update it when the facts change. And please, do not confuse a lower price with a better investment. Sometimes a stock is down because the market is wrong. Sometimes it is down because the business is getting worse. The entire game is knowing which one you are looking at. That is why I like mispricing, but I do not worship it. Mispricing is only useful when the business has a realistic path to prove the market wrong. No path, no thesis, no cash flow, no patience, no execution, no reward. That sounds simple, but it protects you from a lot of bad decisions. Because in markets like this, confidence is cheap, discipline is rare, and the people who survive are usually not the loudest people. They are the ones who keep asking, what would prove me wrong? And that part matters most. So build your watch list, read the filings, look at margins, backlog, cash flow, guidance, debt, and the downside case. Do not buy something just because the story sounds good. The market is full of good stories that became terrible investments because the price was wrong or execution failed. If you are successful, share your success story in the comments so others can stay motivated. And tell me which one of these you think the market is getting most wrong right now. Boeing, Lockheed, Toast, or Vistra. This is for education and research only. I am not your financial advisor, and I am not telling you to buy or sell anything. I am showing you how I would think through mispricing, risk, and opportunity. Your money has to match your plan, your patience, and your risk tolerance. Do the work before you ever put $1 at risk.